Good morning, everybody. Welcome to the Flow Show, Tuesday, 10th of September. And I'm joined today by a special guest. Been a bit of a mess getting him on yesterday, but he's here today. Good morning, Mr. Michael Brown.
Hello, mate. Good morning. How are we?
I'm all good. I'm all good. You?
Yeah, very well, very well. My Monday was immeasurably worse yesterday as I didn't have my usual filming session with you. So hopefully we can rectify that today.
Yeah, unfortunately, no trade-off this week. Our producer, his wife or girlfriend, having a baby. Hopefully that's all going well.
Well, I believe it's his wife, unless there's a girlfriend we don't know about.
You never know. You never know with them Greeks or them Cypriots. We're over there, and we've got a couple of Greeks obviously here that I know they're fun and games as well. Anyway, Michael's here, in replacement of a trade-off this week. I thought I'd bring him on the show, and I'll get his opinion on a few things as we go through all the new stuff, which we'll get stuck into now. Not forgetting, of course, we do have our big sale on, so don't forget to check that out. Grab yourself a decent price for coming onto the ForexAnalytix platform. Righty ho, let's get stuck into it then. Going to start with a bit of data. And over in China, trade balance improved over there, saw a bit of a pickup in activity. Exports rising 8.7% there, beating expectations and the prior month. Imports not up as much as expected, but that's good news for the trade balance at least. A bit of activity over there, but we'll have to see if that's maintained. Over in Japan, one of the ruling LDP lawmakers, Ishiba, says that a complete exit from deflation is the key task Japan is facing. Now, you will know that we're in the midst of a leadership battle over there after Kishida announced he was quitting. So they're all going to be throwing out their campaign lines in the run-up to that context. We have had a story out, sources piece from Bloomberg, saying that the BOJ is said to see little need to hike rates at next week's meeting. So the start of it, I think, all these sources pieces going to start dropping out ahead of that meeting. There's pretty low expectations for next week's meeting, so that's not really telling us anything new, but we'll pay attention to those. Regarding the ECB, Daiwa were out with a note yesterday, and it's made a very good point, something I've forgotten about. What's going to be happening, and this is something the ECB's already told us about, is that as well as cutting rates as part of their normal cycle, they're going to be bringing all their different rates in line with each other. So they've got three rates: the main refinancing rate, the deposit rate, and the marginal lending facility rate. They're all at different levels. And they want to bring those all pretty much in line. So we could mechanically see a bigger cut. They're expecting a bigger cut of the main rate of 60 basis points rather than something else, or the 25 that we're going to get in the deposit rate. So don't be surprised if you see a big rate cut number coming on Thursday. It's not that they've suddenly decided to cut rates more than expected. It's all part of this bringing all these rates into alignment. But if you're in a chat room, then you can read that piece in the newsroom. Right, let's get into the UK jobs data. Fun and games here. For those that may not know, those in our chat room knew, I found a story from the Telegraph saying that part of some state pension guff the government was dealing with, they also leaked out apparently some official wage figures amongst that briefing, saying that wages were set to drop to 3.5%. Now, as I say, they claim this was from official data, unpublished, unreleased, because the Treasury does get figures from the ONS and the like. So I tried a little short in cable on the expectation that if those wages numbers came in much lower than expected, and 3.5% would have been below the range indeed for these numbers, expected range for this, we would have seen a move in cable. That wasn't to be. It came out pretty much as expected, so that one went into the horseshit file. But I'm not going to make any excuses about it. When you see headlines like that, there's times you're going to make a decision and trade to them. But overall, The jobs data looking pretty good. Claimant count softer than expected. Unemployment coming down to 4.1% as expected, so no pickup there. Wages ex-bonus came in as expected, including bonus came in a bit softer than expected, so that's one thing that can play into the BOE, but overall pretty good data. What did you make of that UK data, mate?
Sorry, it helps if I unmute myself before I try and
that
speak,
does
doesn't it? Yeah, I mean, it was pretty much bang in line with expectations. I think it's you need to take the unemployment rate with a little bit of a pinch of salt, because we know that the ONS are still having some difficulty in calculating that, given the relatively low survey response rates. But nonetheless, lowest level since January, which is positive, whichever way you frame it. And a continued cooling in earnings growth as well, which I think is exactly what the BOE will be wanting to see. Although that, of course, needs to be caveated with the fact that we've yet to see the full impact of those public sector pay rises coming into the data. So that could impact when we get the August figures next month. I don't think it materially changes the outlook for BOE policy, though. It was always a pretty high bar to a September rate cut, and this data certainly isn't going to force them into any action. And I think the November is the next meeting where we're likely to get a rate cut from the BOE. Of course, you've still got 4 of the MPC who back in August didn't think it appropriate to deliver a cut then, and I don't think we've seen anything in the data since that meeting that would really convince them otherwise. So yeah, very much kind of as you were, which is really why we've seen minimal, if any, reaction in sterling crosses this morning.
Yeah, exactly, and little change for expectations for next week's BOE. Do you think the CPI data next week could be a bit of a changer if it's a real soft one?
I don't think so, to be honest. I mean, we know that headline inflation in particular is going to be bumpy for the rest of the year, primarily because of the impacts of the energy base effects that we've got coming through. You would expect that core and services prices continue this disinflationary trend that seems pretty well embedded now, but I don't think that, even if we got a much cooler print than we did last time out, I don't think it's going to be enough to force the BOE into acting. They seem, actually, in contrast to the Fed and to the ECB, they seem much more determined to take a sort of slow and steady approach to removing restriction and to normalizing policy. And perhaps that's going to provide the pound with a little bit of medium-term support. But I don't think we're going to see the MPC rushing to deliver another 25 basis point cut 6 weeks after a pretty knife-edge cut at the start of August.
Yeah, no, I think I agree with that. And in the meantime, we'll enjoy the quietness of the blackout period where we get none of them speaking. Though it's been a while since we've really heard from Bailey, which has been a bit surprising.
Yeah, he spoke at Jackson Hole, where he sort of essentially just tied himself in knots by saying, we're cutting rates, but we're not sure we really want to cut rates, and we might actually hike rates again. It was just complete nonsense. But the BOE, realistically, we haven't had any sort of firm forward guidance or inter-meeting communication from the BOE since probably May, before they went into that blackout prior to the election. The only really significant remarks we've had from them since then were Bailey at Jackson Hole, and then the press conference after the August MPC meeting, which is, we didn't see it this morning, but I think that's why the pound and sterling assets more generally are so sensitive to incoming data at the moment, because we just haven't got that concrete guidance from the BOE that we've been used to so long, that markets are essentially flying blind and trying to make their mind up on their own as these jobs and GDP tomorrow and inflation next week, and as that data just feeds in.
Yeah, no, I can agree with that as well. Cool. Right, well, moving on then. There was another little bit of inflation data from the UK. The Kantar Grocery Price Inflation Index dropped again to 1.7% from 1.8% previously. This was really shooting up high over the last year or so ago. So that's really, really come down, which also adds to the disinflation scene we've got here in the UK in part. More inflation. Mexico yesterday, they had their bi-weekly and monthly inflation out, a little softer than expected. Headline CPI coming in at 4.99% from 5.57% previously. Core monthly number there as well coming in softer. So pretty much all the metrics there came in a bit softer than expected. We've got the Mexico meeting this month as well. Over in the US, a little bit of data, wholesale inventories, that came in 0.2, not as much as expected, but it's still a positive number showing that inventories are still being built up, which is good. Better news was the sales number. It reversed the minus 0.3% last month to a positive 1.1%. So again, we're getting some soft landing data from some of the other metrics. Consumer credit was surprisingly strong as well, 25.45 billion, over double what was expected, and a huge jump on last month. This number can be very volatile. I haven't yet looked into the details of that to see if there's any red flags being waved there in terms of what type of credit is being taken out. But we'll keep an eye on that big number to see whether it reverses or whether it's the start of something different. If we do see huge borrowing numbers coming in this data, it could signal that a lot of people are struggling and need to borrow more and more to make ends meet. So we'll keep an eye on that one. Over to some expectations from the banks. Lloyd's, their CFO, sees one more BOE rate cut this year. Sees that largely possibly coming in November. Morgan Stanley, they are keeping their Fed call for 25 pip cut in September and a total of 75 pips in the rest of the year. For the BOJ, they expect them to raise rates in January. For the ECB, they expect a second cut in September, much as everyone else, but they say that they need to see much softer CPI data to bring around expectations for another cut in December. They say the Bank of England is much harder to predict. They expect the next cut in November. They say domestic factors are behind our call for a pause in the September meeting, but a stronger currency and heightened Fed expectations only reinforce the fact that September is a live meeting. Staying with the banks, Goldie's, their CEO, apparently, according to sources, have said their trading business is trending down about 10% in Q3. So it's a little bit of potential forward guidance for the numbers to come. Over in the States, over in the Gulf, we've got this storm that's apparently going to develop into a hurricane today. So if you're trading oil, keep an eye on oil prices. They're not responding too much, but various companies, Shell, Exxon and the likes, are pausing certain facilities and evacuating others. So we'll see what that develops into. And probably the main event today, later on, I don't know how much of a main event it's going to be, more than
Oh no, don't go there. No.
I'm going there. I'm going there.
Come on.
It's funny, you know exactly what I'm going to talk about.
Yeah,
it's the Harris-Trump debate.
Pantomime? Oh, debate.
Pantomime. Yeah, one or the other, mate. I'll certainly have the popcorn out for it. So that's happening tonight, the first time Trump and Harris go head to head. If we recall back to the Trump-Biden episodes, that it's pretty much going to be a circus. I doubt we're going to get any cues from that over what policy is going to be. It's probably going to be them just standing there sniping each other. But it's going to be a laugh to watch. I assume you've got very little expectation for this one, mate, and if indeed you're going to watch it at all.
Oh, well, I certainly won't be up at 2 o'clock in the morning to watch it, that's for sure. Incredibly low expectations. I think it's just going to be a bit of a slanging match, to be completely honest with you. And it's difficult to imagine this sort of significantly changing anyone's mind, really, when it comes to the election in November. I guess the significance of it is that as of the schedule at the moment, it is the only planned TV debate between the two. Usually we would have 3 in the run-up to the election at the start of November, but obviously this is perhaps not a usual election with not your typical candidates, and it seems like this might be the only time that the two of them sort of faced off against each other. So obviously going to attract a little bit of attention as a result of that, but I think it's one for the media to get into a bit of a frenzy about. I'm not sure it's one that market participants should be concerning themselves with too much.
No, and I'll probably watch the edited replay, I think, rather than sit through all that when I get up tomorrow morning.
Well, I'm glad you didn't use the word highlights, because there's probably going to be about 10 seconds of highlights, judging by the last one.
Yeah, about 2 minutes worth of each one slagging each other off.
Yeah, exactly.
Right, that's all I've got on the news headline front. Anything you've seen, mate, that you want to bring to our attention?
Yeah, just one thing actually that I will mention. I popped this out on Twitter yesterday. Yours and mine favorite former central banker Mark Carney looks to be making something of a comeback. Of course, something that has gone a bit under the radar, I think, over the last week or so has been the political situation in Canada. Last week we had the so Justin Trudeau, the Canadian Prime Minister, he has been ruling with a minority government for, well, since the last elections, a couple of years ago, 3 years ago, in fact. And his alliance partner, the New Democratic Party, they have now formally ended what they were calling the Confidence and Supply Agreement, which is effectively the agreement that they had between each other for effectively prop up Trudeau's government. So now he's lost that support. It means that he no longer has a de facto parliamentary majority. Means that if someone were to table a vote of no confidence, then it could indeed bring down the government and lead to early elections. And those elections are due currently in October of 2025. But as I said, that could well be brought forward. Carney, who, of course, former Bank of Canada governor, former Bank of England governor, he's now been appointed as an economics advisor to Justin Trudeau. And it doesn't take a genius to see where this is going, because that election that is now looking like it could be imminent is almost certain to result in Trudeau's 9-year reign in power coming to an end. It is also likely to lead to Trudeau's resignation as leader of the Liberal Party if the opposition Conservatives were to take over. And of course, that then opens the door to Mark Carney becoming Liberal leader and potentially in a few years' time, Canadian Prime Minister. So some interesting political manoeuvring going on there. But I think one thing that is happening, and just as I say, going under the radar a little bit, the Canadian dollar has been pretty much unchanged over the last week or so. But those political instabilities there, particularly given the broader context among the G7 at the moment, is just yet another nation that is experiencing a very, very shaky legislative landscape. Of course, you add to that, we've got the election coming up in the US, as we mentioned. France, they've appointed Barnier as Prime Minister. God knows how long he's going to last, probably about 5 minutes. Germany, of course, with those regional elections a couple of weeks ago, the rise of the AfD, more regional elections in a couple of weeks' time. The political backdrop globally across developed markets is just becoming more and more volatile and more uncertain. And I think it's just a theme that markets perhaps haven't quite picked up on just yet. But I suppose the one, when that was Japan, as you mentioned earlier with the LDP, the one country that does seem to be displaying a degree of political stability, whether you agree with what they're doing or not, is here in the UK, where Labour have obviously got a 170 odd seat majority and are not under any threat for the next 5 years or so.
Yeah, no, that's well, you can call it stability. It's stability in political terms. We'll wait to see from the budget whether it's stability in investment terms, because that's going to be the big one, I think, as we know.
Yes.
And can't wait to cover that one on the trade-off in October.
God, we might be taken off air.
But yeah, it's funny because we've got all these ex-central bankers going into politics. You've got Yellen at the Treasury. You got Draghi, who was PM of France, of Italy. They all seem to want to jump out of central banks and into politics. So yeah, the return.
Yeah, well, of course, Draghi had that big report out yesterday as well into the competitiveness of the EU, which was saying that they need to spend, I think it was 800 billion euros a year extra in order to compete with the US and with China, which, let's be honest, they're never going to end up doing.
Yeah, well, that was one of his big lines, wasn't it, when he was in charge of the ECB, that countries had to increase their fiscal measures to help help the ECB do its job as well. So the guard's a bit similar as well. So there's no real change there. Get someone else to spend the money that they all put in. But anyway, and that German situation, you're right, it's bubbling. We had that story yesterday. It wasn't not a market moving one, that Germany's putting in temporary controls on all its internal borders or its land borders, blocking migrants and the like and whatnot. It's all playing into this politics theme that we've got going on at the moment, isn't it?
Yes, indeed it is, and I think that's an important distinction for people to draw. Quite often you will see headlines cross, and you kind of go, oh, it hasn't moved the market, but it's all just information that feeds into the broader picture. And of course, as new information comes in, it is information that markets discount, and it just helps to either support or disprove the biases that participants already have.
Yeah, very much so. Very much so. Brian, you're quite correct. Brian asks, is here another government shutdown in the US? Yes, we're approaching that time again. I don't know if it's beginning of October or end of September, but the clock is ticking once again on those headlines. So expect that to become a part of a feature of news headlines as we move forward. No doubt we'll get another can kick. Not sure what they can do with this one in the midst of an election. Whether they'll just
No,
make it an easy pass and just shift it until after the election, maybe a temporary can kick.
yeah, I think that's probably what you're gonna see. I mean, the issue is if you think about the sort of electoral side of things. I mean, the deadline is midnight on the 1st of October, so we're not that far away. But I think you consider the Republicans; they want to win the presidency, they want to hold on to the House. I'm not sure they're going to countenance the idea of a government shutdown 5 weeks before polling day, in order which could then easily just be blamed on them. So it's going to be the usual rigmarole of everyone's so far apart, no one can agree on anything, and then as soon as within a few days, the headlines will suddenly change, and it will be there's a stopgap deal that funds things probably until the end of the year or the start of the new congressional term in January. But as you say, just kicking the can down the road once more, as we see every single time this shenanigans happen.
Yeah, maybe one day they'll actually find a solution, a permanent solution for it. But
I wouldn't hold your breath for that.
No, we'll probably be pushing up daisies by the time that happens. let's have a look at what's going on in markets, and well, not a lot to be honest. We might as well start with the Loonie.
Say that would take all of about 30 seconds.
Yeah, exactly. Don't worry, I'm going to get your involvement in this as well, because I'm going to be struggling to find a narrative anywhere. A lot of markets doing the same thing at the moment, just going sideways. Dollar CAD really not doing an awful lot. We got it bouncing around this 50 fib, can't get through the break point 135.80. So really, it's all about just seeing if you can trade the range. If you're looking from the short side, this is your pain level. 135.80 is up to the top of this zone, 136.14s. If we're breaking up through there, something's probably happening, and that might be a trade that then you want to go with. Failing that, you could maybe stay on the short side under here and look for a move down to support, down to at least the figure 135, and then even the zone underneath. This one isn't even following oil. Not that oil's doing an awful lot either, but it's not doing much at all on that one. I'll have a look quickly at oil because I'm still trading Brent, which was actually my play of the day from last week on the old trade-off. It was either play of the day or one of my bits. Look at that.
I believe it was.
Yeah, so
I'm as on the ball as ever.
Yeah, I'll let you off. I'm in longs, and in this one, I'm just trying this support down here, though it's not looking awfully good at the moment. So this was the support level I'm leaning against, as you can see, going down to these lows and beyond. So it's not doing awfully well. We've had, this will be the third attempt now at this 70-50 level. Bounces have been restricted to this former support level, 72.20s, 25. So it's really a bit of a ballpark game whether we're going to break lower below here or break up above there. So I'm going to have a look. I've got a couple more ads in. I'm happy to add down to the $70 mark, but I'll be stopped out if we break under there. But I might not add as much if we do get a break here. I'm not overly keen at the moment, but it is what it is. Levels are holding for now, and I just want to see whether it breaks down or breaks the other way. It has been rallying on this storm stories emanating, but not rallying an awful lot. US oil, as you can see, not doing the same either, or doing pretty similar. Not quite getting down to this low zone down here, 66, 68s or 67s. So it's not quite doing the same as what Brent's doing, but similar pattern. Again, it's going to need to break up above 68, 69 to negate some of this move, or else we're potentially heading lower.
Yeah,
Go on, mate.
Sorry, Matt, I might be answering your question before you've even asked it there. I was just going to say, I think I'd look at the hurricane through the same lens as I would look at geopolitical issues when it comes to crude. Perhaps good for a short-term spike higher as the news crosses and people de-risk a little bit as a result of potential output disruption, but it's not going to be what either Brent or WTI, whatever you're looking at, requires in order to build a more durable and sustainable rally, because that needs to come from the demand side. Even though OPEC have obviously postponed this output hike that was due to take place at the start of October, that's now been pushed back to the beginning of December. We really need to see demand improve in order for WTI and Brent to move sustainably higher. And some of the manufacturing data has started to improve a little bit, but then you look at the data we had out of China overnight, and demand there is still pretty weak, particularly with that soft imports number. So, I don't see much good news on the horizon if you're a crude bull, at least not from the fundamental side of proceedings.
Oh yeah, 100%, mate. I agree with that. And my traders, the guys here will know, is purely just a technical one, just playing off this support area. But yeah, even with this storm news, I've seen it rally $4 or $5 on storm news. It depends how strong it is. It depends how much it gets shut down and how long it gets shut down for, refineries and drilling and everything like that. So that is still a possibility if it gains strength. But I wouldn't rely on the storm for giving me any profits in this one. It will be a bit of a helping hand if anything. Right, let's give you a good one. What's your thoughts on Euro Sterling, mate?
Oh, for God's sake! For goodness sake! Why did I volunteer to come on here? I've actually got a meeting. Sorry, I got it. Euro Sterling, Euro, whichever way you want to look at it. I genuinely don't have much of a firm view on proceedings at the moment. I guess the only thing I would say is that over the medium term, you would expect some further pressure on the euro, not just against the pound, but pretty much across the board. I think of all the central banks out there, the ECB are the one who have the strongest case to deliver both more sizable easing and also quicker easing than their peers. You look at particularly inflation. I mean, headline inflation in the Eurozone is basically at 2% already, and it only needs a sort of cursory glance at some of the incoming German data that we've had in particular to see how significant the downside growth risks are in the Eurozone. So I think Euro Sterling should move lower over the medium term, but as well, not this chart, but I think there was a chart there a second ago shows, it just has this propensity to sort of do nothing for an incredibly prolonged period of time, and then eventually make a break for it. So I think it's more a case of waiting for that catalyst. Are we going to get it out the back of the ECB on Thursday? Probably not. I think it's a 25 basis point cut, and sticking to this meeting by meeting approach, we'd really need to see ECB members or even ECB sources reports take a much more significant lurch towards the dovish end of the spectrum in order to unlock the next leg of euro downside, I'd imagine.
Yeah, we'll wait to see what those sources have to say on. I'm assuming we're going to get a bit of a dovish tilt to those sources pieces. Some maybe wanting a stronger forward guidance on rate cuts, given that economies are bumping along the ground or grinding along the ground, not doing much. So I doubt we're going to get any sources pieces that are bullish or hawkish on Thursday, mate.
I mean, it would be a great surprise if we did, wouldn't it? Although it is interesting that there does seem to be a little bit. I mean, Reuters ran a story the other week around how there does seem to be some disagreement among governing council members, particularly between the Hawks and the Doves. And the Hawks are saying that some of these issues I mentioned in terms of Germany are more structural in nature, and that actually that shouldn't necessarily impact the short-term policy outlook. So, I think one of the things that will be interesting, perhaps not market moving, but interesting on the ECB on Thursday, will be the degree of unanimity among governing council members with regards to this 25 basis point cut, and also with regards to any guidance that they issue.
Yeah, that's a good point indeed, mate. Good point indeed. Right, our mate Ali over in the chat, while we're on Euro Sterling. Oh, right, you're thinking about adding some big money to target 83.95. If we see the pound every man in his dog is long, and if we see the euro it's under pressure, the ECB can surprise markets. Ali, I don't know how long you've been trading Euro Sterling, but I'll say it time and time again. You've got to have patience with this one, and you've got to pick your poison. You've got to pick your levels. Okay. Personally, I would not be looking to short here at market for a move to 83.95. Could it happen? Absolutely. But do I feel that's a decent trade? I think you might get a bit of a better risk reward. Forgetting about your target, thinking about if you want to be short this one, then pick your place, pick your area where you're more likely to be right, and forget your target. You know about me and targets, and just try and make money. Get on a winning trade and see where it goes. Okay, but you've had this 83.95 target in your head for quite a couple of weeks, well, a few weeks now, and we can't get there, and now we're just grinding higher. As I say, it doesn't mean we can't get down there, but you're more likely to get down there if we find a decent resistance point that we can't get through. If that's up here, the current level, 84.45.50, 84.60, 84.80, wherever it may be, if you get some decent price action there, a bit like this, then you might get your move. But until we get that sort of price action, resistance-wise, then I'd be a bit careful, mate. Don't put too many eggs on that 83.95. Just get the trade right first, then worry about your profit after, mate. Yeah, go on, mate.
Oh, sorry. I was just to say the other thing, just on that very quickly. Talk about whether the ECB have the potential to surprise markets. I'm just looking at the OIS curve now, which I appreciate is not necessarily the easiest thing to access if you're a retailer. But we see that the September meeting, the meeting on Thursday, we've already got 25 basis point cut fully priced in. We've also got a total of 63 basis points of cuts priced by December. So what the market's saying there is effectively between now and the end of the year, the ECB are going to cut 2.5 times. So actually the potential for a significant surprise from the ECB is relatively low, because market participants are already saying there's a 50% chance that they do 25 basis point cuts, September and December. There's a 50% chance that they do 3, that they go in September on Thursday, that they go in October, and then they go in December as well. So actually, even if the ECB were to lean significantly into one or the other of those scenarios, which I don't think they will, I think they'll keep their options open. But even if they were, the market is already discounting a pretty decent chance of either scenario anyway. So the chance of that causing a sort of significant market move is perhaps a little bit more limited than you would expect at face value.
Yeah, 100%. And see, this is why I like this guy, because he's just as sensible as we are as well. And it's all about rate expectations. It's going to be the same with the Fed next week. We've been playing this 25-50 pip game for a couple of weeks now. So where are we right now going into the Fed? The market more on side with a 25. So if you know that if they go 25, you're going to get a lesser outcome. And only if they shock with a 50 or indicate that a 50 is really on the table and they're looking at it in earnest for maybe the next meeting or meeting after, that will be the shock move. So same with the ECB. The market knows where it's at with the ECB, as Michael says, 2, possibly 3 cuts. So you need to see something from them outside of that to bring a decent move in the euro. So always know those expectations, particularly when we're going into these events.
Absolutely. I think that's I don't want to go off on a complete tangent, but I think that what you just outlined there is actually probably the most reasonable base case for the September Fed meeting next Wednesday. Is they do 25 now, and then they flag a readiness to move more quickly if the data softens or indicates the labour market conditions worsening. I mean, that's effectively the message that we had from Christopher Waller on Friday, saying that the labour market is softening, but we don't believe it's deteriorating. If it were to deteriorate, happy to front load cuts, happy to do more. I think that's probably the sort of message that we hear from the Fed, almost a case of 25 basis points now, but if the data softens before the November meeting, of course, by that point, the election's out the way as well, then they're happy to move a lot quicker.
Yeah, and that's actually a point I made in the chat room yesterday, or speaking to someone else on Skype, can't remember which, but keeping 50 basis point cuts open, i.e. not shutting them down completely, is the very same as what they did when rates were rising. You know, they talk about bigger cuts and doing bigger stuff because it does half the job for them. It tightened financial conditions for them without them actually having to do anything. This time it's the same on the way down. Keeping 50s on the table loosens financial conditions without them actually having to move rates as much as 50 basis points. So that just having that optionality, as I say, is doing half the job for them because markets are already loosening financial conditions. So they can get what they want without actually moving rates that as much as they might possibly do.
Yes, absolutely. Which is why you will probably, for the next 6 to 12 months, see Fed speak lean in a more dovish direction, because it will just massage those expectations and give that little bit of further easing in financial conditions that they want to see as they slowly but surely normalise policy.
Yeah, thanks, mate. Catherine just asked, what are the BOE rate expectations? I think we're about 25, somewhere between 25, 30% chance next week, mate.
It's come back a bit this morning. So, I mean, this is from Bloomberg, so depending on what source you use will be a little bit different. But 18% chance of a cut next week from the BOE, according to the curve at the moment, with 47 basis points priced by the end of the year. I would just caveat that by saying we do have the August CPI figures due on next Wednesday morning, which is obviously the day before the next BOE announcement. So potentially that pricing could shift a fair bit ahead of the BOE next week.
Yeah, thank you for that, mate. Hope that helps you out there, Catherine. Matthew, please feel free to share any winning trade ideas. It's very dull markets currently, so you've been sitting on your hands.
I think that is a winning trade idea in itself.
That is a winning trade, very much so. Yeah, I'm in the same boat at the moment, Matthew. I've got my ranges. I've got the places I want to trade. I'm just sitting and waiting to trade them. If you're looking for opportunities, obviously we spoke about dollar CAD, euro dollar. Here's one potentially as well. I'm looking at selling up to the 112, all being well, depending on what that move is at the time. There is maybe a case for going short if we do break below 25.20s in euro sterling. We're just moving below this 40s area and this fib, just trying to hold it as resistance. So there is the possibility of a breakdown, but how much it's going to give you, I don't know. If you want to look at one that's a bit more cleaner, Aussie dollar, been pointing this out, my level here, 66.40s, 45. We are walking along that line at the moment, can't move below it. So if you get a break, that might be something to go with, but given the volatility and what's going on in markets, you might only get maybe 20 pips out of it down to the next level, which, 20 pips is not to be sniffed at, but what you don't want to do is maybe get in a trade, it has a little run down there and then pops back up again. So when you get quiet markets like this, there's two things you can do. You can either just sit and wait and, practice that patience discipline, because when you start trying to chase a trade, that's when you get caught out, trading in the middle of a range, and, then you're sitting offside for hours and then something happens and whatever, you end up losing money because you weren't disciplined enough just to wait for your levels. But, you plan breaks, you can plan holds, you might want to try longs off this area while it's holding, but what's it going to get you? Again, it's getting you maybe 20, 25 pips once you're taking spreads into consideration and whatever. So good money, not to be laughed at, but it depends. I wouldn't get a trade in here and think, right, I'm going to short here. It's going to 65 in half a session. So when you get markets like this, just plan. There's nothing wrong with doing nothing. If you're not getting your levels, then just sit and wait and plan for when you do get your levels.
One thing that is
yeah, go on, mate.
Oh, sorry, mate. I was going to say, just very quickly, one thing that is marginally interesting with the Aussie dollar. I say marginally because things are still relatively quiet. We did see both the Aussie and the Kiwi as well, relatively classic risk proxies. Both traded a little bit softer yesterday, despite the S&P and Nasdaq rallying 1% or 1.5%. So just interesting that that sort of traditional correlation seems to have perhaps broken down a little bit.
Yeah, it wasn't part of that rally down to that Nvidia stuff. Or was it that Nvidia stuff from
Yes,
last week?
that was
That
Goldman
analysis.
having a shocker with their. It was Chat GPT, wasn't it?
Yeah,
Not realizing that the website address had changed. Yeah.
absolutely hilarious. But yeah, if we I'll take a quick. I won't keep you too long, mate. But I'll have a quick look at S&P while we're here. If I can find the right chart, there we go.
I think everyone knows what I'm going to say, no matter what sort of chart you bring up.
Yeah, buy the dip.
Of course.
Well, it's working. If you pick your levels, this 53.90. I had it on my chart all since this point here, and give or take, that's where we held just ahead of the 50 fib. We've had a decent bounce. We got back above this area, which I think now is going to become a bit of a pivot area. Already got a bit of semblance of support coming in this 54.50 area in this fib here, but now it needs to push on. It needs to take out some of these more short-term levels, 55, 55.20, all the old places where we found previous support and resistance, 55, 50, 60s. That's really going to be a key level there. If we're getting above there, then we're probably going to get up towards the highs at least, and then I'll be thinking about potential break trade above. So as you can see, Matthew, it may not be anything that I want to do now, but I'm still planning and keeping an eye on what the prices may do that will then bring a trade. And if it doesn't happen, it doesn't happen. Right, well, I've kept you here long enough, mate. I'm sure you're busy. What I will do is I'll just pop your Twitter handle in the chat there. Anyone who doesn't know of Mr. Brown, you can start following him there. I'll apologise on his behalf because half his tweets are all bad puns. Hence why my red and yellow cards are always to hand.
You're too harsh, mate. You're too harsh.
Yeah, it's my show. I can be harsh on my show. You can give me back on the trade-off. So yeah, give him a follow there. He does have very good insight into markets and what's going on in the world. So definitely worth a follow. Yeah, thank you very much for coming on board, mate. It's been a pleasure as always.
No, thank you very much for having me, mate. And hopefully I can be back again very soon.
Yeah, definitely, mate, definitely. And thank you to all you boys and girls for coming, supporting us here on the Flow Show. Hope we've steered you well today, and we'll see you all on Face and catch you tomorrow. Have a good one, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.